Hey, everybody, welcome back. Brad Myers here again, 20-year home inspector turned real estate agent with Howard Hanna Real Estate Services right here in Fulton County, Ohio. Again, I have with me today Kim Dietrich and Heather Sapp. Kim is a 20-year veteran in the real estate world. She's kind of everybody's go-to person when it comes to keeping things organized. She knows the real estate law inside and out. Heather is a whiz when it comes to everything finance. Any of us that have any questions, we always go to Heather for the answer. So there's a couple of questions I'd like to get your guys' take on. Last week, the Feds met again, and we seen that they did not raise the prime interest rate. And I think a lot of the reason for that is that we're seeing inflation coming down. My question is, how do you think this is going to affect interest rates going into 2024 and 2025?
Well, obviously, it's going to make it favorable for buyers who have been shut out here for a little while with those higher interest rates, whether it be because the debt to income didn't work or, maybe they couldn't afford the higher interest rates. So obviously, as they start to come down, that's going to bring more buyers back into the market, maybe some of them that were sidelined, or even some of them that had government pre-approvals. You're going to see them hit the market again.
Right. Kim, what do you think?
Well, I think it is going to open your buyer pool. They're going to feel a little more comfortable going out and purchasing that home that they want with home prices higher than they had been. That limits your amount that you're able, what the higher the interest rate, basically the higher your payment, which means typically the lower value of the home you can purchase. So I can see that swinging a little bit the other way, or at least leveling out a little bit.
And I agree with both of you guys. And what I've been trying to tell my buyers is we're predicting interest rates to start coming down next year, 2024, mid to high sixes. And in 2025, we may even see a 5% interest rate. Mm-hmm. And I know that's going to be very tempting for a lot of buyers to wait until 2025 to buy, but I think if you do that, you're gonna be back into a feeding frenzy in 2025. Mm-hmm. I think if you buy next year in 2024, you're gonna avoid the rat race. Yes, you're gonna pay a little bit higher interest rate, but keep in mind 2025 is only a year away. That's not that long to carry a little bit higher interest rate because you can always refinance in 25. And also that whole time that you're carrying that higher interest rate, you're also building equity in your home.
So one of the things that I have been religiously saying as rates go up is that you date your rate and you marry the house. If it's a house that you can't live without and you can afford it, take the higher interest rate, refinance when rates come down. And like you said, right, the housing market only is going to increase in value. So, you're not hurting yourself in the long run by any stretch. But if you wait until rates come down and everybody floods the market, you're going to get into bidding wars on those houses, and it's going to inflate the prices.
That's right. You're going to be rushed into making a decision. You're going to be competing with multiple buyers. You're not going to have time to have the house inspected. It's going to be the same rat race we've seen 2 years ago. Okay. So, and my next question is, why haven't we seen home prices come down as interest rates have went up throughout 2023?
I would say it's simple. It's inventory. It goes back to supply and demand. We learned in our basic economics class many, many years ago that, demand for something and a small supply is going to increase the cost of that, whatever that supply is, whether it's houses, cars, gasoline. So the more you have in the market, the more level your prices become. The fewer you have, if you've got more buyers than you have homes, they're going to drive that price up. Interesting, we received stats today from our local board that talk about, where we were in 2022 to today. And in many areas, the housing market or the average cost of a house has raised significantly just in a year's time. So from November of last year to this year. So that's good for the seller.
Yeah, yeah. And I've got a graph I'm going to bring up here.
Mhm.
This goes back 10 years to 2013. You can see we had a 9.5 month supply back in 2013.
Mhm.
And you come to 2023 and we only have a 2-month supply.
Mhm.
So right there's your lack of supply. And, you know, obviously we don't have the demand that we had 2 years ago, but we still have a significant demand. But until we see this supply come up closer to like the 6-month,
Mhm.
that's going to keep home prices up, in my opinion.
It will. It will. But if you're that person that's ready to sell their home, now's a good time to do that. You know, the last many months have been, but I see it continuing. There's buyers out there.
Yeah.
So,
Yep. There are. Yeah. I think we're kind of in a seasonal lull
sure.
right now. Just November, December is always a slower time. I
Mhm.
think once we get into January and February, I think you're going to see a lot of buyers come out, especially since the Fed didn't raise that
Right.
prime interest rate. I really think we're going to see buyers coming out.
You always have the seller that argues, oh, nobody wants to go look at houses in the winter because it's cold and it's snowy. You know what? They do. Some of our best months over the last couple of years have been January and February.
Yeah. It
I
seems
feel like
like
'cause that's
I
when you know.
remember,
Sorry, Brad, go ahead.
no, I remember in 2020,
Mhm.
it was spring market the entire year. And
Right.
it never
Right.
slowed down. It never slowed down.
Yeah. Yeah. They always say spring market's April. But it depends. I mean, we had a spring market in November.
Right.
You know,
Yeah.
Like the buyers that are shopping right now when it is kind of a lull season, like, you know, they're not tire kickers. They're serious. They are trying to get into a home. They want, you know, to
Right.
find something.
Right.
And they know that other people are like, oh, I'm just going to wait until the first of the year, like it's holidays. So they're looking at that as an opportunity to maybe get something that
Yep.
nobody
And,
else.
you know, sellers need to keep in mind too that, you know, this is a good time to get your house on the market because the best time to sell your house is when your neighbor isn't. You know, it's
Valid.
when you don't have that competition.
Mhm.
It's going to make your house much more appealing.
And it's already clean for the holidays.
Right. Exactly.
Except for mine. But think about how pretty the homes show. You know, we always talk about curb appeal. You drive by a house that's got all the lights on and you look inside and you see the Christmas tree that just, you know, it's
Yep.
appealing.
Sure.
Definitely looks better.
Yep. And if it doesn't have great landscaping, it's dark by 5:30, so you can't see it anyway. So, all right. So, on to the main topic. How does my credit score impact the mortgage rate? Say I'm a buyer with a 650 credit score versus a buyer with an 800 credit score. Is there a drastic difference in what I'm going to pay for my mortgage rate versus the guy with the 850?
Well, it depends on what loan program you're in. You know, someone with an 800 credit score is probably going to have a lot more options than somebody with a 640. And every loan program has their parameters for, you know, what it costs to do the loan or what the lenders charge to do the loan. So your credit score matters to me. Like, not only am I looking at like a low debt to income ratio, I'm looking at your, you know, strong financial history, and higher credit score. Like, those three things are going to be what determines why you're going to get the better mortgage rate. This is an analogy that I think is cute to use or that people can relate to. And it's, you'd probably hesitate to lend money to a friend who usually takes forever to pay you back or doesn't pay you back at all. That's how lenders feel about mortgages. So they want to lend to people who have a record of on-time payment to creditors. We're relying on that credit score as an indication on how the borrower meets his obligations. So higher credit scores, experts say, reassures lenders like me that the borrower is going to pay the money back.
Right, right. That I think it's a great analogy. Another question that I get from a lot of buyers is, and I'm sure this is going to seem like a pretty simple question to you guys, but you sometimes you need to put yourself in the shoes of a borrower that doesn't do this all the time. What is the difference between my closing costs and my down payment? Because seems like I get this question a lot.
So your down payment is going to be the money that you are required to bring for the loan program that you are in. So let's say that you are approved for an FHA loan. The requirement for that is 3.5% of the sales price. That has to be money that comes from you. So it could be money from your 401k, from work. It could be a gift from grandma. It could be money that you already saved up. It could be, maybe a Roth that you are going to borrow against. So there's different ways to make your down payment. Your closing costs are going to be what you're paying for the lender and your title company to close this loan for you. So it's going to be your lender fees, your title fees, your escrow setup. For most loans, you're going to have an escrow, which is your taxes and insurance that you pay. If a lender says to you, like, your cash to close, or specifically for me, I shouldn't speak for all lenders, but if I say to you, Kim, your cash to close is $5,000, that is going to include your down payment. That is all inclusive for me. So I'm telling you that what you're bringing to the table for closing is this amount. That includes your down payment. So it's not $5,000 on top of your 3.5%. So
Okay.
just need to make sure that you clarify those with your lender. And if you don't understand, ask. Like, sometimes we forget because we do this every single day. No question is a dumb question.
One thing to remember in there too is there's a couple of things that you're going to have to pay for prior to, and that we call those prepaids, but that's your inspection. Always get a home inspection. And then you also have appraisal. We need to make sure that the house is safe and appraises for value. So those are things you're going to pay for up front. Those are not included in the numbers Heather just gave you.
I think a good rule of thumb for the appraisal is probably right around 500, and that's probably pretty close for the inspection as well. So I think a good rule of thumb for both is probably $1,000. So I think we're about ready to wrap it up. Heather, if anybody has any questions, how can they get in touch with you?
You can always reach me on my cell phone with a call or a text at 517-462-8811. I know it is the holiday season. However, I will be around. So if you have any questions or there's anything that comes up, please feel free to reach out.
Because of the holiday seasons, I think we're going to probably take a couple weeks off. We will meet back here the 1st of January.
Sounds good.
Okay. Great. Take care, guys. Thank you.
Thank you. Bye-bye.